Hi, I'm Jimmy. In this video, we're looking at Intel stock, ticker symbol INTC. So we're going to look at the basic outline of Intel's business plan. We're going to look at some pretty big developments that have happened in Intel stock recently, like they lowered their dividend. Then we're going to look at, is Intel worth investing in today? If so, where's the best place to try to buy it? Now, one thing that we may notice is over the past year plus, Intel stock is down a decent amount. Now, this is a stock that I personally own. My average entry price is a bit under $38 per share. So for me, the question is, do we want to sell the stock? Now, to best come up with our strategy going forward for Intel stock, we're going to ultimately try to map out their long-term plan. They actually call this plan IDM 2.0. Plus, we're going to look at the capital allocation strategy. Okay, so let's jump into the long-term plan. So IDM 2.0 is short for Integrated Device Manufacturer. Basically, it means that they design and build the chips. Now, they break out the growth of this phase into three primary segments. The first segment is the internal factory network. And if you've seen any of the news recently about them opening new plants or upping the amount of manufacturing that they have globally, this is probably what you've heard about. They're investing a ton of money around the world. They're putting up new plants in Ohio. They're putting some up in Arizona. They're building a big one over in Germany, another research and development one over in France. So they're spending a ton of money to ultimately up their capabilities from a factory standpoint. Now, this is important because one of the things, we saw the chart before where Intel stock was tumbling. One of the big problems that they've run into is that they have not been able to meet their manufacturing goals. They have run into problems time and time again, and it's mostly either because they're running against their own capacity or they're running into their own development issues. Most of this whole plan is designed to correct those issues. That being said, the second part of this phase is external foundries. Now, external foundry is a good example of an external foundry. It would be a company like Taiwan Semiconductor. TSMC is one of the big ones. If you're curious who they are, they actually make most of AMD's chips. AMD is a competitor of Intel. Taiwan Semiconductor makes most of them. So, Intel has historically used companies like TSM. They've used them for a while, specifically around, GPU, which is graphics processing units, but they're planning on doing it more. They've already been using external foundries like this, but when they announced, hey, we're pushing out this IDM 2.0 strategy, we're willing to go to external foundries more often. So we don't want to get caught up thinking that just because they're expanding the amount of factories that they have, their locations around the world, that they're bringing everything in-house. They're actually doing the opposite. They're expanding their global footprint, but also willing to push some of their manufacturing to the specialties of other companies. Then the third segment is sort of the flip side of this. This is the internal the Intel Foundry services. So if you got fabless companies like Qualcomm and Broadcom, well, basically they allow, if you guys are making chips, we'll make a piece of those chips for you. We'll make some of those chips for you. It's basically a service, kind of like them going to external foundries. Well, they'll also be a provider of services to other companies so they can provide their specialty to other companies. Again, this is a way for them to try to cast a wider net and capture more business going forward. Now, one of the downfalls to this is they have to remain somewhat competitive on pricing. Historically, Intel's margins have been quite good. Those margins are going to get squeezed a bit here, and that is something we have to expect going forward, and we'll touch more on that when we try to come up with a fair value for Intel stock. But for now, let's jump back to the stock chart over the past year, and here we're going to focus more on the capital allocation strategy that has emerged over the past year. Now, capital allocation is crucially important. This is basically, how does the company spend the money that they make? Warren Buffett says that capital allocation is one of the most important things that a management team, any management team in any industry, it's one of the most important things that they do. How do they spend the money that they make? To illustrate that, we're going to look at their dividends. So you might have heard the news with Intel that Intel has cut their dividend. So for many years here, this is their dividends per share going back to 2004. And for many years, Intel was fairly consistently increasing their dividend. But then we could see with these like bluish, greenish lines here that if the dividend per share is dropping. Now, if you're wondering why the 2023 numbers are a little bit higher than 2024, well, that's actually because they announced the dividend cut after the first quarter. After the first quarter dividend was already in place. So it's not a decrease from 23 to 24. It's just 2022 numbers were still in 2023 numbers, if that makes sense. Basically, dividends were about $1.46 per year, and now they're going to be about 50 cents. So they're chopping off about 2/3 of the dividend. Now let's look at that from a total cash perspective. So this chart here, this is the exact same chart, except it's in the dollar amount spent by Intel on an annual basis. Again, ramped up for a long time, big drop down overall. We can see that as of 2022, they spent about $6 billion in dividends. Well, using the new dividend amount of about 50 cents per year, they're going to save about $1 billion per quarter. So is this a good capital allocation move? Well, it really depends on what side of the table you're on. If you are here, if you're in Intel stock for the dividend, this is likely a bad move. It probably hurts you. Maybe you already jumped ship and went on to a different stock. But if you're the company, if you're an investor in this company for the long term, I actually think this is a very good move. Why are they spending $6 billion a year when they need multiple billions of dollars to roll out the whole strategy we were just talking about before? Now, another reason that they'd want to save the money that they would be spending on dividends is to try to keep their credit rating intact. So let's take a look at where their current credit rating stands. So this is the approximate scale of how companies get credit ratings. So you might have heard about, hey, a company's AAA corporate bonds. This company's a AAA company. That is the highest possible credit rating. It doesn't matter which agency we look at. There are 3 primary agencies, as you can see here, business credit rating agencies. First, we have Moody's. When we think about Intel's Moody ratings, they are currently rated at A2. Then we have Standard & Poor's. They have them, slightly different scale, but at about the same spot. They have a single A rating. Then Fitch, they actually have Intel's credit rating a little bit lower at A-. But we can see that all 3 credit ratings fall into about the same scale. They're in the upper medium quality rating, which is considered lower risk, just a slightly higher interest rate. By the way, the lower you fall down this scale, the higher your interest rate will be on the bonds. Anything in yellow or below is considered non-investment grade. They used to call these junk bonds, but now they're called non-investment grade bonds. But you want to be as high as possible. So by cutting their dividend and saving some money, well, ultimately what they are able to do, or what they're trying to do, is to prevent their credit rating from falling any further. If their credit rating keeps falling, it makes borrowing money in general more expensive. Ideally, just like a person, most companies want their credit ratings to be as good as possible. Okay, now the next leg of this whole plan that Intel is putting in place is a deal that they announced last year with a company called Brookfield Asset Management. So we saw all the expansion that Intel is doing going around the globe. One of the places that they're investing, it's about $30 billion, is into Arizona. They're putting up 2 different plants or 2 different factories, and out of that money, the $30 billion or so that they're supposed to be spending, well, they cut a deal with Brookfield Asset Management that Brookfield will put up about half of it. Intel will put up the other half. It's actually 51% Intel, 49% Brookfield. Now, this is important because this is right in line with shoring up enough capital that they don't really mind if cash flow is low or negative right now because they're spending all this money for the future. But if they can shore up different forms of capital, whether it be Brookfield or cutting their dividend, if they can do that to position themselves for not now, but for 10 years from now, well, I think that long-term investors are far more likely to do well. Plus, if the CHIPS Act doesn't bring in quite the amount of money that Intel or some other investors thought that they were going to, that's okay. At least they have a backup plan. Okay, that being said, let's jump into the fair value for Intel stock. So this is our discounted fair value calculation for Intel stock going out the next 6 years. By the way, this is our investing platform that we're building, a way to quickly value companies. If you'd like to get access to this website, I'll leave a link in the description below. But basically, we have the fair value for Intel stock being about 41 bucks per share. The current price is about 28 bucks per share. So right now it looks reasonably undervalued. Now this is including if you look at the 2023 numbers down here, well, this is including the fact that 2023 is supposed to be very negative according to the 13 analyst estimates that we have. 2024, the numbers are supposed to get a little bit better, slightly positive. 2025, starting to ramp up a bit. And then we have the computer estimate a bit further out after that. Now, the fact that we see a jump to a bit over 14 billion here, I don't have a problem with that. Before the whole big spending spree that Intel has gone on, they had well more than 14 billion in free cash flow. So it jumping back up there by 2026 seems very reasonable. Now, if the numbers get anywhere near there, the stock is worth about 41 bucks per share, which brings us to the question, do we want to be investors in Intel stock? Now, for me, I obviously like the company. I already own the shares. I have no intention of selling the shares. The key to this whole thing as to whether or not this is a good investment is, one, look at the dividend yield. The dividend yield, although it has been drastically reduced by about 2/3, is still going to be about a 2% dividend yield, 1.5% dividend yield, which isn't going to be all that bad for a company like Intel. The real value here is going out the next 5 years, going out the next 10 years. If we can deal with the volatility that the stock is likely to go through, if we could deal with this volatility, I think that Intel stock has enormous upside, assuming that they can execute in the plan that they've laid out. So if you'd like to get access to this website, or if you want to learn how to research stocks, we do these different investing live streams in the private investing community. Again, I'll leave links in the description below. Thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.